Imagine a company so small and financially fragile that under any normal reading of market behavior, it should be drifting into quiet irrelevance. Yet, its story twists in directions that defy the expected path. Before we dive in, the trading strategy for the current market conditions is included later in this episode, so make sure you stay until the end. And if you are watching this through Shorts, you will need to use the full version link below the video to hear the uninterrupted explanation and the full trading framework. I optimized this mention to keep the flow natural because the strategy segment is where everything connects. Now imagine this. A company loses more than half its revenue in 1 year, falling from roughly $30 million to about $11 million. Its net loss expands far beyond $20 million. Its workforce barely reaches 67 people. Under typical market logic, investors usually retreat from companies like this. Liquidity drops, capital raising becomes difficult, valuations compress, and attention fades. But SEALSQ does not behave like a typical company. Instead, it breaks the expected script and moves into a territory that feels like a financial anomaly. Across a single 52-week span, its stock trades near $0.40, then explodes to almost $11, then settles around $4. Normally, a semiconductor company of this scale does not experience this level of volatility. These kinds of violent surges and collapses usually appear in biotech names with major clinical catalysts, or in meme-driven equities fueled by viral attention. Yet SEALSQ shows this pattern without any corresponding earnings growth. That alone signals that non-standard forces are at work. The deeper you look, the more unusual the story becomes. During the time its price surged and fell, SEALSQ's revenue shrank sharply. Losses widened significantly. And instead of struggling to raise capital, SEALSQ raised more money than ever. In December 2024, it raised around $25 million. In May 2025, it raised another $20 million. Under ordinary circumstances, repeated fundraising by a shrinking company causes investor fatigue and lower pricing. Yet, SEALSQ's access to capital expanded. Then October 2025 arrived, and something happened that broke almost every rule of typical financial behavior. SEALSQ raised roughly $200 million by issuing common stock, pre-funded warrants, and long-dated warrants with strike prices around $9. Under normal market conditions, a company generating only about $11 million annually cannot pull in $200 million from institutions. Yet Heights Capital Management led the round. This is not common market activity. It implies that institutions see something beyond the current financial statements. After the raise, SEALSQ reported a pro forma cash balance close to $400 million. A company with $11 million in revenue holding $400 million in cash is extremely rare. Historically, such uneven proportions appear in firms with strategic government ties, national security importance, or future infrastructure roles. This enormous gap between revenue and capital is one of the central mysteries. To understand possible explanations, we must examine SEALSQ's narrative. SEALSQ positions itself as a builder of post-quantum security infrastructure. The company claims that quantum computers will eventually break current cryptographic standards. It asserts that its secure elements, RISC-V and ARM-based microcontrollers, smart card reader chips, and PKI systems will serve as replacements for a world transitioning to quantum-resistant security. PKI, or public key infrastructure, is the foundation that ensures devices and networks are authentic. SEALSQ claims it is building quantum-resistant PKI, including roots of trust engineered to withstand quantum-level attacks. If that is accurate, SEALSQ is not describing a product line. It is describing the foundation of future identity systems. Then come the global partnerships, a United States-based post-quantum root of trust platform in late 2025. A quantum corridor node in Grenoble in France, work with IC Alps for autonomous vehicle safety. Integration efforts with Landis plus Gyar for smart grid security in North America. A collaboration with the Swiss Armed Forces for quantum secure satellite systems. A personalization center initiative with Keynes Semicon in India. A $25 million personalization project with Quantix Edge Security in Spain. Under ordinary semiconductor business timelines, partnerships of this scale begin showing up in revenue within several quarters. Yet SEALSQ's revenue declined further. That gap is not trivial. It is the heart of the mystery. One possibility is that quantum-resistant systems require long validation cycles. Government contracts and national infrastructure decisions often take years. Another possibility is that many partnerships are early-stage pilots intended to establish presence rather than immediate revenue. A third possibility is that SEALSQ is racing to occupy key global positions before regulatory standards finalize. And there is a final possibility. The narrative may be running ahead of execution. If this is the case, the massive fundraising could be a hedge against future challenges rather than a sign of imminent growth. Investors feel this push and pull. The company looks like both a shrinking semiconductor business and an ambitious global infrastructure candidate. This contradiction produces fascination and concern simultaneously. From a technical perspective, the ambiguity continues. In late November 2025, the stock trades near $4.5. It sits above short-term averages but below longer-term resistance levels around $5 and $6. Under typical technical interpretation, this means early recovery with structural overhead pressure. However, SEALSQ previously surged toward $11 without any earnings catalyst, which shows that narrative-driven equities can override technical barriers. Looking ahead, we can analyze the stock through short-term, medium-term, and long-term lenses. Short-term, the price appears range-bound between roughly $4 and $5.50. A breakout above $5.50 on strong volume usually signals a move toward $7. A breakdown below $4 usually leads to a retest of $3. Medium term, the determining factor is revenue conversion. If smart grid deployments, automotive security integrations, and PKI rollouts generate real revenue, the stock could move into the $6 to $9 region, which aligns with institutional warrant strike levels. If revenue stagnates, dilution pressure likely forces valuation downward. Long-term, everything depends on the timing of global quantum-resistant security adoption. If the world mandates new cryptographic standards and SEALSQ holds early positioning, its cash reserve could become a powerful springboard. If the transition is slow or competitors secure certifications first, SEALSQ's capital may not translate into sustainable value. Before we close, I want to thank everyone who watches to the end, subscribes, likes, comments, and shares the video externally. Your engagement helps keep this research going, and I will continue working to deliver better content for you. In the end, SEALSQ stands as one of the most puzzling equities in the market, a company with shrinking revenue and rising losses, yet massive capital and global ambition, a company defined more by possibility than by present performance. The defining question remains simple, yet profound. Is SEALSQ an early pillar of the quantum-safe future, or is its narrative running far ahead of its fundamentals? This was ValueStir.